Very good evening to one and all. On behalf of SRCF ICA, a hearty welcome to all the delegates who have all gathered here to attend this program. Now let's all welcome with warmth in our hearts and with big round of applause our CA Madhya Krishnan on the stage, please. Thank you, sir. Thank you very much for accepting our invitation and being with us. Now let's all raise for our ICA motto. Thank you all. It's my great advantage to take you through the profile of our CA Madhya Krishnan briefly. Our CA Madhya Krishnan is a partner in well-reputed firm located in Chennai for the past 15 years. He is a graduate in CWA, CIMA, DISA and completed the valuation course of ICAA. He started his training and career in a well-reputed firm since 1993, where he worked almost for 6 years, and later in the again a well-reputed firm in Middle East for the past 3 years. He handles statutory audits of large MNCs, listed companies amongst other entities. He also supports the internal audit assignments of Gulf firm as well as other engagements like business valuations, due diligence, SOX testing. He has presented many papers in seminars relating to bank audit, accounting standards and auditing standards at various SRC platforms as well as in other forums like Society of Auditors and Chartered Accountant Study Circle, etc. He is a joint secretary of the Society of Auditors. So with this, with the permission from all of you, may I request our CA Madhya Krishnan to take over, please. Thank you all.
Good evening, everybody. So today's topic is on Ind AS 19 employee benefits, which is maybe a very dry topic and a difficult topic to understand. Before we start on this particular topic, I would like to know from the participants whether you're all aware that there are 2 new movies that have started. They got released yesterday. 2 major movies. Are you aware of it? So, are you aware of another 4 movies that have also got released yesterday? So, it is similar to that. So, we have a grand GST program having been there yesterday, today and tomorrow, 2-day program is happening. And this is one of the side releases that is happening. Anyway, I'm happy to see a double-digit attendance here. I think, okay, yeah, what will, I'm sure quality will make up for the quantity in terms of the audience participation. And with that, I invite you to stop me wherever it's required. Let us have a free flow of information. After all, it's a very closed gathering. Having said that, this CPE seminar will not go for 3 hours. It will, I'll try to finish it maybe in a couple of hours' time. I have not timed my presentation. So, but at the same time, I want to ensure that most of the concepts are given to you. So that's the thing. So we will be starting off with the learning objectives in the standard. what are the learning objectives, why we need this particular standard, brief peek into the history of employee benefits, and the type of employees covered, and what are the type of employee benefits which have been covered in this particular standard. Before we move to the presentations, can somebody tell me what are the different types of employee benefits that are covered in this standard, AS 15 or Ind AS 19? Can somebody give me a broad framework of what it is? Anybody, please?
Gratuity.
Sorry?
Gratuity.
Okay. Then anything else?
There are four
The-
types.
Sorry?
4 types.
There are 4 types of, the whole standard can be broken into 4 types. When you look at it from a macro level perspective, it can be broken into 4 types. The first one is short term. Can somebody give me the second one?
No, post-employment.
Sorry?
Post-employment.
Post-employment benefits. Okay. So that is one. Then you have other long term, you have termination benefits. These are the 4 types of employee benefits that are basically given here. The slides are not moving, I don't know why. Can somebody call the person from the institute, the technical guy? Yeah, that's good. So I'll start off with this disclaimer. This presentation that I prepared is not an original work. I have taken it from different sources on the internet. I referred to many of the actuaries' websites in terms of getting some useful inputs. Some of the diagrams which are there are taken from different sources. With that particular disclaimer and acknowledgement, I would like to start my discussion. So some of the learning objectives in this particular session would be to first understand the scope of the standard, one. To categorize the different types of employee benefits which we just did at a macro level. Apply the accounting treatment. We should understand what is the type of accounting treatment that needs to be done. Determine whether a plan is a defined contribution or benefit plan in terms of post-employment benefits. Look at an actuarial report. I'm sure many of us have seen the actuarial report and we have to understand the assumptions over there. Then enhance our understanding on the various terms and then the disclosure aspects. How many people in this audience are from the industry? One. So all the others I presume are practicing chartered accountants? Okay, thank you. So this presentation is going to be broken into a general introduction. We are going to talk about compensated absences. Then we are going to talk about some terms from the guidance note of the institute. Then we'll touch upon provident fund, gratuity. We'll also get into actuarial standards. Not only auditors have standards, the actuary who does it, he has some standards. We'll take a peek into that. And then we'll look into the disclosures and accounting policies. Then we will also look at the accounting standards, AS, the old AS, ICAI standards versus your revised standards. Then you have the old standard itself, company accounting standard rules. There's a new exposure draft that has come up, which is moving the standard more towards Ind AS. So we look into those comparisons, and then we'll also compare Ind AS with IAS, that is IFRS. So all these comparisons also will be done. We'll look into that a little later. We'll also be touching about some aspects on FRRB. Does anyone know what is FRRB? Financial Review Reporting Board. So that is one particular part of the institute which will pick up any accounts of a company. Just look at the accounts and try to find out what could be the matters of possible non-disclosures or way in which the accounting standards are not done properly. The FRRB is a important wing of the institute which also drives the quality. So they have come out with some observations on employee benefits. So we'll be touching about some of these things also here. We'll also look at some expert opinions and case studies. So why do we need a standard for employee benefits? So why do we need a standard? Someone tell me, why do we need a standard today? So I remember when I joined the CA profession, there was one standard called AS15, and that was the last standard in that series. We had AS9 for a long time, and then we had another 5-6 standards, and it stopped at AS15. So why do we need to have a standard on employee benefits? So the reasons could be now that from a manufacturing scenario, India has moved into a service sector in a big way, IT enabled services. So employee benefits standard is very, very important, where human resources, manpower is the plant and machinery. So we need to ensure that the employee costs, the employee benefits are all aggregated properly, accounted properly, provided properly, and disclosed properly. So that's very important now to have employee benefits accounting standard. And today the type of employee benefits are very, very different. It's not that in the good old days we had only few things, salary, PF and things like that. Nowadays there are a lot of different types of benefits which are being given. So how to categorize each of them in those 4 buckets, that's something that we need to look at and look into it. And fair value principles. I think this is one of the first standards where the fair value aspects, because actual valuation is nothing but a fair value. Even before Ind AS, all this IAS, IFRS came in, we had that AS15 where the actual valuation was, basically given as a mandatory thing for companies above a certain number of employees and all those things. Fair value concepts have been brought into the Indian system. I think this is one of the first standards. And there are more disclosures for certain type of employee benefits. We'll see it as we go. This particular standard does not cover the employee share-based payments, ESOP accounting, which is covered by a different standard. So we are not covering that today. And the accounting and reporting by the employee benefit plans. So we may have a separate provident fund trust, a gratuity trust fund. That particular entity has to prepare its accounts, give disclosures. We are not covering that particular aspect today. We are looking at a company with employees. So that is the only thing. The scope out of Ind AS 19 is these 2 aspects. Of course, when we discuss today, I would also not be touching upon certain things like multi-employer plan, state plan. These are all there in the gratuity and defined benefit plans. These are a little more, I would say not complicated, but not being used in a regular manner. So I'm not be covering those aspects today. Just want to keep you informed. So this is the history of employee benefits. It started out in 1974. So we had a standard which talked about basically treatment of retirement gratuity in accounts. Only that particular aspect, only gratuity. Then in 1995, accounting for retirement benefits came into picture. Today, retirement benefits is only one part of the 4 different parts of employee benefits. Then AS15 was again revised in 2005, 2005, 10 years later. And then almost one more decade later, Ind AS came into picture, which basically adopted the principles of IFRS or International Accounting Standards. So that is the path in which it has come up. Obviously, the scope of the standard has increased, and as I said, it is one of the first places where fair value measurement concepts have been there. And if you go into IASB website, International Accounting Standards Board website, look into AS19, it will give you a history of how that particular standard evolved over a period of time. So when we adopted sometime in 2005, which is basically a IAS version, the gap of say 20%. So we had basically we didn't travel through time in terms of all the life cycle changes that happened to the particular accounting standard. So what kind of employees are covered? So we have to look at, employee benefits. What are the employees who are covered? Do they cover, say, factory workers? Do they cover union staff? Do they cover casual labor? Do they cover the directors, independent director? Do they cover the full-time director? So that is something that is needed. It is very interesting to note that the standard does not define the term employee. Employee is defined elsewhere in labor laws. So this particular standard does not define the term employee, and it's applicable to all forms of employer-employee relationships. It could be formal, informal, verbal, contractual, and it could be full-time, part-time. So it applies to a managing director. It also applies to the chauffeur of the managing director. Sometimes he may not have a particular contract. His salary may be paid in cash, but he may be there for 10-15 years. It is according to me, it applies even to him, though it may not be specified specifically. So we need to look into those aspects. And also the concept of contract for service and contract of service, that is something that needs to be looked into. So where we have a limited direction and control, and versus the employer-employee relationship. So one is a professional relationship, whereas a contractor, there is no employer-employee relationship, then employee benefits will not apply. In other place, when it's a contract of service, there we direct the person what to do, we control the person, so there the employer-employee relationship comes. So these are all basic concepts which I thought I'll quickly touch upon. And these are the 4 types of employee benefits: short-term, post-employment benefits, other long-term benefits, and termination benefits. Again, post-employment benefits are divided into 2 main categories: defined contribution plan and defined benefit plan. Can we have some examples on each of these? Can somebody tell me what is a short-term employee benefit? Some example? Bonus. Bonus is a short-term employee benefit. Something before bonus? Salary. So salary is a short-term employee benefit. Can somebody give me an example of a termination benefit?
Surrender leave.
Sorry?
Surrender leave benefit.
Okay. Yes, you said? Okay. Voluntary retirement schemes, VRS could be an example. And defined contribution plan? Provident fund. Contribution plan. Benefit plans? Sorry? Sorry? Pension? But the most common defined benefit plan?
Even gratuity also can be.
Gratuity? Okay. And what could be other long-term benefits? Okay, that is I think that is exactly opposite short-term benefit, the first one. So what could that be? How do you distinguish that? Something that we need to look into. So this one here, salaries and wages is basically short-term. Social security contribution like ESI and all is short-term. Profit sharing could be other long-term depending on the timing. Bonuses short-term, but it could also be long-term. There could be long-term bonus plans also over a period of time. VRS is a termination benefit. Gratuity PF we covered. So this is basically the thing, but remove this arrow. This arrow is not there. So you have short-term, post-employment, and contribution benefit plan, and then that's okay, sir. That's fine. I think carries. We have something called projected unit credit method, which is being linked to both your benefit plans as well as other long-term plans. We'll come to that a little later. So we'll quickly touch upon, see what I'm going to do is first knock off from our discussions short-term, knock off other long-term, then knock off termination. These are all very, very small areas which we can finish very quickly, and then we will come to post-employment benefits. So that's how I've structured this. I've not structured it in this particular manner. I thought the small items can go out very quickly. So short-term employee benefits. So any benefit which is expected to be settled within 12 months. So you have 31st March, something is going to be settled within 12 months from the balance sheet date will be taken as short term. So salary is paid quickly, so there's something which is there. And for this initial recognition, any standard has initial recognition, subsequent measurement and all those things. So the recognition is going to be the exact undiscounted amount of the short term employee benefit. which is basically paid for exchange of service. Basically historical cost without any discounting is going to be the amount which is there. In profits and bonus sharing plans, legal or constructive obligation, there is something which has to be looked into. It has to be reliable estimate should be there. Sometimes if you are not able to make a reliable estimate, you may not be able to account for it. It may have to make a disclosure in the notes and accounts. And if the employee has to remain for a specific period, even if it is a short-term plan. For example, you have a short-term bonus to be paid during Deepavali, and on 31st March you are supposed to make a provision for the short-term thing. So Deepavali comes in, say, October or November. So you take the number of employees, you take the calculation, how much you have to pay based on some criteria, and make the calculation. But you have the policy states that these employees have to be there in your roles at the time of payment of the disbursement of the bonus. There could be attrition during the intervening period of 1st April to October or something when Diwali occurs. And we would have seen that in the past also there is a history of attrition. So that can be factored, even though it is undiscounted, the same cost has to be taken. This particular attrition can be factored into the calculations, and we say that maybe 2% of employees leave during the intervening period. We remove 2%, 98% can be provided for. So that standard allows you to do that in case of short-term employee benefits. And termination benefits. So they are also mostly short-term, right? When somebody leaves VRS, you immediately pay them out. Very rarely you have a payout which is extending over many months. But termination benefits are taken as a separate carve-out. We'll see why it is little later. So you have something called the legal or constructive obligation over here. So I will touch upon that also. This is one factor which is a difference between our company accounting standard rules and international accounting standards. International standard says even if you have a constructive obligation to pay, then you need to provide for it. A constructive obligation is nothing but what happens, the expectation that a particular employee has from the employer, because the employer has been doing it for many years consistently. It may not be a legal requirement, it may not be a mandatory requirement, but the fact that the employer has been making such a payout regularly year after year can raise an expectation, and therefore this constructive obligation is also reckoned for computation of the costs and provisioning in Ind AS as compared to old accounting standards where it was not necessary to do so. This is one important change or difference which is there. So this is the definition of constructive and legal obligation. Then we come to other long-term employee benefits. Also in short term we have compensated absences, leave and all those things, but we are going to discuss about it a little later separately. So other long-term employee benefits are just 5 paragraphs in the entire accounting standards of Ind AS 19, and it is something which says that it is not expected to be settled within 12 months. That means it is something which will be settled after 1 year. We have the normal working capital cycle and all those things. So the long-term paid absences, we have many examples here, including Jubilee long-term benefits. For example, an employee may be getting an award at the end of 10 years, at the end of 20 years, at the end of 25 years. I'm sure many of the companies which we are auditing, that's the sole industry person here, will be having this type of awards. Strictly speaking, those awards would come under other long-term employee benefits. And there is a cost component to it that needs to be provided for ab initio itself. So, anybody in any of your client company, do you have this 10-year award, 25-year award? It may not be part of the contract, but it is being done regularly. So it is a constructive obligation, but under Ind AS it needs to be provided for. Earlier it is not a legal. It's only if it is not a legal obligation, it need not be provided for under AS 15. But if it is a constructive obligation, it has to be provided for under Ind AS environment.
Will it come under the definition of salary type and it's a 10 year?
Sorry?
Will it come under the definition of salary if the company is giving a 10 year?
10-year thing.
Yeah.
Under salary?
Yeah. not the salary, the one which we are talking about. Once they complete 10 years, then give you some benefits like in the
Yeah.
form of cash or case.
Correct.
It will come back to the salary, definition of salary.
It will, when a company finishes 10 years.
Yeah, no, not the company.
Ah.
Employee completed 10 years
Mm.
service. They give some benefits in the form of maybe the vouchers.
Mm.
So whether that will come back as a definition of salary.
Not come back to the definition of salary. This is basically long-term employment.
Employee benefit.
It's a long-term employee benefit. It is not a salary. Salary is something which is paid on a monthly basis. You know, every day you work, the salary increases. If you don't work on a particular day, subject to your leave and all, it's a loss of pay. So this particular thing may not be part of salary. It will be more like a long-term, other long-term employee benefit only.
So do we have to provide for that, expecting that?
Yes, we have to provide for it. If you have, say, 100 employees, what is the probability? Now, that is where here we have to look into the measurement principles. So, what is the probability that you have 50 employees today? How many of them may cross 10 years, or how many of them may cross 25 years? If we have such a particular rule or some practice which is happening in your company. And as a going concern, the company is a going concern, so you need to factor that and provide for it. But in many cases, it may not be very material from a financial statement perspective. But technically speaking, you need to provide for it.
How is it treated in computation of income? Memo.
But whose income?
That is in income tax statement.
No, it is not allowed as a.
It is not allowed.
Allowed as an expenditure.
It is not allowed. Simple.
It is only
It's a provision made. Since it is not paid, it will not be taken as a deduction in income tax. Personal tax doesn't matter actually. It's only a company provision. It's not attributed to a specific person. So individual tax doesn't come. Company thing, it is added back. As simple as that. So that's why you have an actual valuation that is coming in over there.
And see, in some cases, suppose if there are some referral schemes. If a company, if a staff brings in refers an employee who's been appointed as an employee,
Yeah.
they are paid some no problems. So they are paid some benefits. Will this also get covered under this long-term benefits, or will it be a short-term?
The referral charges, in my opinion, will not come under employee benefits at all, because it is not payment made for any service as an employee. It is more like a commission paid, though it is from an employee.
Actually, what happens is finally they add it to the employee's form 16 and they deduct tax also.
Okay, a scope out here is also taxation.
Yes.
So I'm not discussing tax here. So, but if you ask me for the nature of it, it is not a salary. It is not salary, so it should not come under your salary section at all. It is more like a commission paid. But commissions for marketing people are also taken as salary, right? You have income tax cases. I'm not taking income tax at this moment. But the nature will not be a employee benefit. So in those cases also, once the person refers and then as per the policy, the person joins, or after 3 months, there's some conditionality, it needs to be provided for in the accounts. But it is not an employee benefit. So termination benefit. So how is this different from other types of employee benefits? So basically this is not a benefit that is paid for a service. It is paid for a person who is leaving the service basically. So that's why you don't bring it as part of the short term or other long term. There are some companies where the VRS is not paid immediately. It may be paid over a period of time. They may have a scheme where they say that, okay, we have a scheme where everybody who is above 50 can take this VRS, and an amount is calculated, say half a month's pay, and as if taking the age of the employee till the date he retires, say 58 years old, and then this is paid to them on a quarterly basis or a yearly basis, and there could be some interest component also involved in that. Those could be long term, again because the payments are made after 12 months also, including first 3 or 4 quarters in the current year, There could be some payouts happening later also. But even those things will come under VRS, termination benefits. So the initial recognition has to be done. Maybe it should be present valued. The amounts which are going to be paid after 12 months would have to be present valued. So that is how the termination benefits are computed.
So VRS lump sum payment around
Sorry?
discounted cash flow method only.
Discount account, yes sir.
Discounted cash flow method only, the VRS benefits are set
Absolutely.
in lump sum.
Absolutely. It has to be discounted and then shown. Whether or not the employee gets an interest, it has to be discounted and shown, and then that interest portion will be unwound over a period of time. So again, in the termination benefits, mandatory retirement benefits are not termination benefits. Yes, please.
Government securities or
Sorry?
Rate of
rate
discount.
of discounting.
Ah,
At what rate should be discounted?
rate of interest. Rate of interest, you can take the discount rate which we are going to discuss in this one, gratuity, government bonds. That one something you can take. It's not an issue. So if there is a termination which is at the request of the employee without any offer from the employer, it is strictly speaking technically not a termination benefit. But then if that happens, you anyway have to provide for it. It cannot come under this category but a different category. So again, exchange for service and exchange for termination. So there are some technical aspects in the accounting standard Ind AS 19. I'm not getting too much into it. But if only thing I want to say here is, if the benefit is conditional on future service, there could be sometimes some termination amounts paid. On the condition that the employee continues for 3-4 months or something like that. In those cases, that particular portion will not be VRS. That will be a payment made for those periods of time, and therefore it will be provided as and when the time elapses. You may have to do a split up of the VRS in those particular cases. And sometimes the benefit will be in the employee benefit plan. There could be some union agreements, employee benefits, where they say that upon termination some payouts should be made. Even though it is as per the plan, the union agreement, it could be a VRS and then taken as only a termination benefit. That's what it says. And you have to, at what point of time do you recognize a termination benefit? Let us take an example. We are in, say, 1st of February. The company gives a VRS scheme. The VRS scheme normally is a invitation for the employee to offer. Am I right? It's an invitation for the employee to offer that he wants to leave, and then the offer is accepted by the company. So the company invests an offer. Some employees may offer to move out of the company, and then the acceptance is taken up by the company. That is the way in which it moves about. So at what point of time should a VRS amount be recognized in the books of accounts? I give an open VRS offer on 1st February. Some employees come back and say that, okay, we are ready to take up this offer on 1st of March. The company has a meeting on, say, 20th of March. They have another meeting on April 10th also. The 20th meeting, only 5 employees are selected right away. They feel that these employees need not be there. They don't have a problem. They immediately accept the offer. For the balance 15, they are still contemplating what to do. And later on, they say okay to 6 employees. They can also leave on April 10th. So this is how the company has accepted the offer on 2 different dates, March 20th and April 10th. At what point of time should you recognize the termination benefits? Can we take it as a post-balance sheet event and recognize it on 31st March for the April 10th one?
Effective date of VRS.
Sorry?
Effective date of VRS.
Effective date. What if the termination date is going to be, they are all going to leave from 30th June only? So only on 30th June they have to take. Am I right, sir? Okay, fine. But there is also a clause, a third bullet point which says that when the entity can no longer withdraw the offer, at that point of time it has to be taken. They are also tying it up to restructuring costs. You have Ind AS 37, which is your contingent liabilities, contingent assets, where they talk about if the company announces a restructuring within the department or any type of restructuring, they have to provide for restructuring costs. part of the restructuring cost could be VRS also. VRS or any employee restructuring. So they are also tying it up there. So there could be situations where a particular company says, as part of the Industrial Disputes Act, they enter into an agreement with the labor union saying that all people will leave from, say, 30th of June 2020, and they agree today itself. There could be some conditions also. Out of 100 people leaving on 30th June 2020, 10 people have to leave today. They want to get rid of some people. If the conditionality also happens, then definitely on June 2020, some people are going to leave. There is no two ways about it. In those cases also, we may have to make a provision for them today itself on 31st March. Of course, it could be a present value. You can do a present valuation and we have to make a provision. Many times these type of places, the provisions are not made because people say that they are anyway going to work for next one year, and then they make a provision at the time of leaving. So this particular trigger point needs to be kept in mind. So what is the definite thing of not possible to withdraw the offer? There's some criteria which has been given in Ind AS. I just jotted down here. So the measurement will be like short-term benefits. If it is undiscounted for 12 months, less than 12 months. If it is more than 12 months, you will have to present value it. So we touched upon disclosure, short-term benefit, other long-term employee benefits, and termination benefits. The disclosure requirements in all these three cases are same. Very, very simple and very, very negligible. It says no specific disclosures are required. Nothing specific, no format, no table, nothing. It only makes a statement that you disclose, and if there is a related party disclosure, please give it. So that is also covered as part of Ind AS 24 related parties. And Ind AS 1 requires certain disclosures on employee benefits. As long as these two aspects are taken care of, there is no other specific disclosures for the three heads in employee benefits, namely short-term, other long-term employee, and termination benefits. So we look into compensated absences now. Leave. So is compensated absences, leave, everything is same. So is leave a short-term or long-term? Is it short-term or long-term? Sorry? Short-term.
Government of Tamil Nadu has declared 14th as holiday. It has to be compensated on 9th February.
Okay. What are the different factors? If we as auditors have to take up an audit of a company and we're looking into the leave area, what is the first thing that we need to look at? What are the different factors which we need to look at? We need to take up the leave policy of the company. So, based on our experience, how could the leave policy be different for one company from the other company? What are the different characteristics that we can look at? Carry forward. So, there could be some companies where they'll say that there is no leave that can be carried forward. If you have annually 25 days of leave, say 5 days sick leave and 20 days casual leave, whatever it is, they will say that nothing can be carried forward. In some other companies, they can say it can be carried forward. So you have a decision tree, carry forward, not carried forward. Can we bring down the decision tree a little more? In terms of carried forward, how do we look at it? Some companies would say you can carry it forward only for the next year, 1 year. Some companies will say you can carry it forward for more than 1 year also. Then comes the question of, some companies will say you can carry it forward till the time you retire. And there is another branch which says that you can encash the leave, or you can only take it as a comp off. Basically, you can utilize the leave as a service during the service. So, comp off or encashment. So, these are different types of decision trees which are there. So, accordingly, the compensated absences could be short term or long term, depending on the policy of the company. So the first thing as auditors, before we get into compliance with accounting standard, is to look at the employee leave policy of the particular company. And if the company has no leave policy, what do we do? the company has no leave policy, we have to look at the actual practices and evolve the policy. They may not have a written document, but then we need to see what is happening. Especially startups, they may not have a policy, but they may be practicing something. We may have to jot it down and start formalizing it. So you have accumulating paid absences. So that is the definition which I have been given, that can be carried forward and can be used in future periods if it is not utilized in the current period. And it could be vesting or non-vesting. That is, vesting means they are entitled to a cash payment for the unused amounts, unused entitlement. Non-vesting, they are not entitled to a cash payment for unused entitlement on leaving. So this is the definition of vesting and non-vesting as far as employee benefits are concerned. Vesting and non-vesting definition is different in ESOPs. The definition is different here. So what happens is when the obligation arises as the employee renders services and increase the entitlement of future periods. So the obligation keeps coming in and it should be recognized even though it is non-vesting. So there could be cases where it says that the employee can only take comp off, they cannot encash the leave. Let us say that he can carry forward leave for 5 days, maximum of 10 days. Every year he can carry forward maximum only 5 days, subject to a cap of 10 days or something like that. But you cannot encash it at all. You can only take this leave later on, the later years, for which there is no restriction. But if you don't take it, you retire, you cannot encash it. If this is the policy, do we have to make a provision for it as of the year end? No? How many people say no? How many people say yes? You have to make a provision. Okay. So there is an expert opinion on this also, which says that you have to provide. It says you have to provide, and it also gives a reasoning of why you have to provide. So the third bullet point, as I said, the obligation is existing and it is recognized even if the paid absences are non-vesting. Although the employees may leave, just like we talked about the Diwali bonus, the attrition rate can be factored inside, no problem, you can do that. But you have to make a provision. It could be 90% because if 10% attrition, whatever it is, but you have to make a provision for it.
What is the value you will put for that? Suppose I am accumulating and I am exhausting at the end of 25th year. What is the value you have to then?
What is the cost?
Yeah, what is the cost? Monetary value for that?
Correct. You're absolutely right, sir. If it is a short term, you know the cost.
Yes.
If it is long term, it goes to other long term. Right? When it goes to other long term, we saw the diagram, PUC method, actual valuation. So we need to, your question is bang on target. What is the cost for that? So if the employee is going to take comp off after 5 years, today his salary is 20,000 per month, but later on it may be 45,000 after increases. So the 45,000 may have to be provided for now. So it is basically actual valuation that needs to be done for compensated absences which are not short term. So actual valuation has to be done.
But there's not going to be any cash flow, right? When he utilizes in the later years, then where is the need for a provision?
We'll look into this, sir. It's an expert opinion. There's institute expert opinion, but I've only culled out the 1 or 2 important paragraphs. The query is sought the opinion of the EAC as to whether the company is required to create provision for accumulated leave, half pay and all, forget it. If so, how the provision is to be operated, since the half pay leave are not to be encashed. From an accounting angle, the nature of unencashable leave is similar to that of encashable leave insofar as unencashable leave provides the right to an employee to receive salaries and wages for the period for which he avails leave. Basically, he takes leave today, he is paid for it in avail leave. For encashed leave, without even taking leave, he gets money. So basically, the expert opinion says, from a cost perspective, it is same. This is what the expert opinion says. You don't have to make a payment. So supposing a person takes leave tomorrow, you pay him salary, right? It doesn't go on loss of pay. There is another aspect that when you take leave the next year, it is on leave basis. You take the leave for the current year, exhaust it, and then dip into the carry forward leave. That is one concept. Assuming a person has exhausted the current year leave, he has 5 days of opening balance. He takes the next day leave after exhausting current year. For that exhaustion of the opening balance, that day he is paid for it. How much he is paid, sir? How much he is paid for that day when he takes leave? He is paid as basic, he is paid as DA, he is paid as HRA, employee's contribution to PF, he is paid everything. When you encash the leave, how much are you paid? The policy will say basic plus DA. In fact, the cost of comp off to a company is much higher than cost of encashment, depending on the policy of the company. Most of the cases, encashment is a very restricted salary thing, basic plus DA, only that they will encash. But when you take off, though you may not get money in your hand, you are actually paid salary with all the full benefits. So the cost for the company is much, much higher. With this, let us quickly run through this. That's why I said cost of vesting and non-vesting may be different. Yes, boss.
Manufacturing units, the manufacturing units, particular person, if he is taking a leave.
Can you use the mic, please? So that
In manufacturing unit, if a worker is taking a leave on next year for accumulated, for example, 20 days leave, so actually the efficiency of manufacturing and the production is diminishing in there. So that means it is a cost to the company, but there is no efficiency is coming up there. So encashing, if he is doing the encashing, actually the cost is lower there. Here the cost is higher in terms of production efficiency.
cost is higher.
Yeah.
That's what I said. Cost is higher when you.
That means that we are going to pay full amount.
Correct.
Yeah.
Correct.
Actually, there is no work at all. There is no work at all.
Correct.
But in case of encashing, we are paying that money, and he also works it the other day. Still he works.
No. That encashment is for working you are making the payment. The salary, actually if he has more leave, supposing on 31st March he is leaving, let us say he is leaving the company, he has 5 days of leave with him. Only if he takes off in future he can take it, he can do that. You are paying him for that day. But for not working, you will have to make a payment, right? See, he is having extra amount with him. So you are actually making a payment to him for the future days. So assuming the person completes his employment completely and he has 5 days of credit, he cannot comp it off because his employment is over. If he is able to encash it, if there is encashment available, that is an extra cost for the company. You are going to pay him for April 1st, 2nd, 3rd, 4th, 5th, 5 days, as if he is working. So the cost remains the same. So it is something which is a very logical aspect which we need to look into. But that is, many companies do not provide for leave encashment. So that's something that we need to definitely look into. There is an expert opinion. It's basically a logical aspect which is there. So non-accumulating leave, they do not carry forward the lapse as and when they go on. So there is no liability to be created for non-accumulating leave. So this is expert opinion we discussed now. So as we said, understanding the leave valuation, we have to understand the leave policy first, as we said. Many companies are not clear on the leave policy, we need to look into that. And we have to understand the consumption patterns. That is very important because depending on the policy, how much they consume, because if it is going to be anything other than short term, if it is a short term, somebody can accumulate the leave first of all, then you have to make a provision. If they are not going to accumulate the leave, there is no provision. Simple, it stops there. If they are going to accumulate, and then when are they going to take it? If the company says only in the next 12 months you can take it, then you have to simply make a simple computation on the cost. There also, they can either, if you give an encashment also there, some companies will say whatever is accumulated can be encashed only. Then it's very simple, you do it. Some companies will say you can only comp it off. Then the cost will increase. If you have a mix of both, then you have to, and there are different cost elements as we discussed now, then you may have to put a mix based on past history, that's why the use of estimates will again come into picture, and make a simple calculation and make a provision for it. But if the accumulated leave can be taken off after 12 months also, then the actuary will come into the picture. He will come into the picture, then he have to see how much leave is getting consumed, because the consumption pattern is after taking the current year leave, how much is taking that. So, and then the actuary will see how much is going to consume over a period of time, and in those buckets what will be his salary, all those aspects, and the end of the period, if he is going to leave the company, termination is going to happen, transfer or retirement, whatever it is, can he encash it or not? If he cannot encash it, then there could be a possibility that there is some accumulated leave which has not been utilized also. He will discount that also. If he can encash it, then that accumulated leave will be costed at a lower value. So all these things will be done by the actuary based on the inputs given by the company and based on past history also. So there is a lot of actual valuation for leave if it is accumulated and can be utilized by the employee, encashed by the company, employee after 12 months. So that is something which we need to relook in our client accounts and take a call accordingly. So as I said, availed during employment can be consumed, it could be encashed, the termination, or this is of one particular way of looking at it. And if it is availed during employment, it could be valued at gross. If it is encashed during employment, it is valued as per policy, which is usually basic salary, basic and DE or something like that. If it is encashed at the time of termination, again it is only basic salary. So the cost aspects differ. So this is only the same thing brought out in a different format, normal logical flow over here. So compensate absences, actual gains or losses, treatment. So you are going to have actual gains or losses if it is other long term. If it is not short term, it is other long term, you will have an actuary doing it, you will have actual gains or losses also. Now should that go into OCI? So now in Ind AS we have other comprehensive income in which you have the in the respect of gratuity, it goes to the other comprehensive income. Items which will not be circulated back to profit and loss account, you have that particular place, that is where it comes into, actual gains or losses. Will leave also go there? If you see many companies, when they take the actual gains or losses, they give the disclosures for both gratuity and leave encashment. They give 2 columns with previous year also, gratuity, leave encashment. Many times gratuity will have funded also, leave encashment you may not have a funded amounts. The actual gains, they will take that row for both liability movement and asset movement, take the net amount and take it to OCA. They will take it for leave also. If any of the companies have taken it for compensated absences leave also, it is wrong. They should not take it. That is because in OCA it talks about remeasurement of defined benefit plans. The OCA definition in Ind AS 1, which gives the categories of what and all should come in other comprehensive income, it says that remeasurements of defined benefit plan should come into OCI. Defined benefit plan is gratuity. Leave encashment, though it is actually valued, is not a defined benefit plan, it is a other long-term benefit. Therefore, it should not come under OCI. That also should come into profit and loss account. We have had cases where in the first year of implementation of Ind AS, actual gains or losses of compensated absences have been taken to OCI, and the company has in the subsequent year corrected the error, and for correction of error in Ind AS you have to go back to previous year and change the numbers. You cannot do it in the current year P&L alone. So there have been a lot of cases where this has happened, and this is one place where FRRB also is looking into it. The moment they see that this is there, it's an FRRB point. So you have to be very, very careful in this particular place. Any questions? Should this be provided for? An employer has a practice of making lump sum payment on occasion of festival or grants advances against informal benefits. So should this be provided for? Who says no? So the guidance note says that
There is no fixed policy.
it is basically a
lump sum payment.
yes, sir.
Normally there won't be
Lump sum
any-
payment.
Yes.
Correct.
Lump sum payment, there is no fixed policy. It will decide it as and when it comes.
Absolutely, sir. We have to look into it. It depends on which period it pertains to. If the management says there is a lump sum payment which is factored based on some numbers, for example, for all the employees based on the number of, suppose a marketing person, number of sales he has brought in for a particular period. If it is linked to a particular period, it should be, and the period is the previous year, and 31st March it has to be provided for.
Normally it is all decided based on the performance of that particular year.
If it is not a particular year, we need not do it. But if it is for a particular year, we have to do it. In fact, there are many companies where it is not for a particular year. It is at the discretion of the management, but they do it year on year. They do it year on year, but honestly speaking, when they look at it, they may have some tinges. 20% they may see what is the profit of last year, and that may come to human mind being what it is. That may also reflect or bias their numbers. But then they may actually do it for the current year, and it could be a very discretionary thing as per the management. And it's also again of how they record it in their minutes or in their internal notes. So if it is very discretionary, you need not provide for it. So again, here the auditor's judgment has to play a lot over here. I would invite any comments on this. If there's anything anybody has if there is a very specific framework which says that based on last year performance, we do a KPI, key performance indicator, and do a calculation, it has to be provided for. If it is a discretion of the management, it need not be provided for. And if it is the second one, it is better that the auditor brings this in the management representation letter, not as an audit evidence, but he has got this explanation from the management, he has recorded it, he is also convinced based on many years. There could be 1 year where they have not made a payment also. It could be there. So he has to bring it in this management representation letter and record it for his own benefit, for peer review, and to back up his judgment of not making a provision or not insisting the provision from the management side. So employees who have worked for less than 5 years. So there is a startup company, and the company is only 3 years old. Should they go for a gratuity plan at all? Should they go for a gratuity plan, or should they start making provisions? Payment of Gratuity Act says after 5 years. So should a company which is only 3 years old, it has 70 employees, startup company, they recruit engineers, they pay salary of 40,000 rupees because this is a BPO for a foreign company, and they do some work and export it. So they have 40-50 employees, and they're going to slowly grow up. In the first 3 years, third year you go and do the audit. Do you think you should make a provision for gratuity?
Yes, if it is a going concern.
Sorry?
Yes, if that is a going concern. So we should provide it.
How many agree with our gentleman here? Yes.
Because there is expectation that the gratuity will be paid to the employees once the company becomes 5 years.
Okay. We should make a provision. Okay. So this is what it says. This is again from the guidance. This is all guidance which was there in AS 15 itself. I'm not bringing it from Ind AS 19, but the same principles are there. So I've just brought it here for our discussion purpose. So there is a probability that the employee would serve for the minimum period of 5 years and become eligible for gratuity. So the good probability is there on a going concern basis. The company should first continue, then the employee should continue. With all these things, factors, company continuing is taken for 100% because unless you have a going concern issue and all those things over there, you can definitely do that. But the employee continuing, you have to go for actual valuation. Go for an actual valuation, make a provision. You may not go for a plan, but you have to make a provision in the books of accounts. This actually we discussed it when I'm entitlement to earned leave, we already discussed it. I'll skip it. The costing of earned leave also we have discussed. It is again there in the guidance note of ICAI on AS 15. Unutilized employee benefits, we'll skip it. So interim periods, how do we make a provision? We have many companies where listed companies or unlisted subsidiaries of listed companies, where it is very crucial we do a quarterly review and all those things. It's very crucial to ensure that the numbers are flowing correctly. You don't make a provision only for the year end. We may have to make it on a quarterly basis. So it says that the same principles as used in the annual financial statement should be used. The frequency of reporting should not affect the measurement of annual results. So you have to take it as benefit payable for 12 months. You have to make a use of estimate for the 12 months, and then do a divide by 4 for a particular quarter and do it. Many companies, practically what they do, if they're large companies, they even do an actual valuation every 6 months. There are some companies who do it every 3 months also. But you are allowed to use of estimate based on last year and take a call on this. Post-employment benefits. In this context, I would like to just say one thing. The way in which the standard has moved, are we aware that in old AS 15 revised, not the exposure draft, revised AS 15, which we have been following till India's came, it had a paragraph which said actual valuation can be done once in 3 years also. There's a particular paragraph which said actual valuation can be done even once in 3 years. But we used to do it every year for accounts closing. But that is something which was there in the old standard. Paragraph 58, if I am not mistaken, of AS 15. Post-employment benefits. This is the largest area in employee benefits. So it is retirement benefits or other post-employment benefits. It could be defined benefit plan or a defined contribution plan. So can somebody tell me what is the difference between a benefit plan and contribution plan? In simple language. You told me that defined contribution plan is PF and defined benefit plan is gratuity. So how do we distinguish something which is a contribution plan and something which is a benefit plan?
Contribution, that is also contribution from the employee.
Like
In case of contribution plan, that is also
yeah.
In case of contribution plan, that is also contribution from the employee.
Oh.
Benefit plan, full benefit is provided only by the employer. Just so, not inside.
Okay. Any other things, sir? So you have heard of the Hero Honda ad which used to come, fill it, forget it. So contribution plan is very similar to that. Pay it, forget it. Don't bother about, you pay it out, forget it, that's it. Your contribution is done, your duty is over, your responsibility is over. What that fund earns, all those risks are with the employees. The risk is pushed to the employees. PF fund, whether it's a PF is sent to the PF commissioner's office, you make the payment to the statutory authorities, that's all, your job is done. In a benefit plan, the risk does not go away. It stays with you. So in a gratuity, what happens is that if there is a shortfall due to actual risk and investment risk, don't ask me what these are, it is there in the standard. So it says actual risk is something where the benefits will be less than expected. How it will be less than expected? Because of fluctuation in market value, or there's investment risk. The investment itself has a credit risk which could be there. So these are all the risks which are being mentioned. The risk is with whom? If it is with the employee, it is a contribution plan. If it is with the employer, it is a benefit plan. So we have to take the risk, we have to fund the shortfall. So that is the basic difference which is over here. So there is an example where an entity has a history of increasing the benefits for former employees to keep up with inflation. So again, here is a constructive obligation which moves a defined contribution plan to a defined benefit plan. So even though it is not mandatory, if the company keeps doing it for say pension or something, you have to pay so much pension. But they take the inflation, based on inflation they keep on increasing it. Then the amount is not fixed, right? It goes based on a factor. Then actual valuation will come into picture because this is defined benefit plan. So that's how the whole concept works. The defined contribution plan is again straightforward accounting. Each period it is same. It could be short term or long term, but most of the contribution plans are all, in the Indian scenario, it is all statutory liabilities which has to be paid within the next month and all those things. Very rarely we have other long term. So it is all short term. So provident fund, is it a defined benefit plan or contribution plan? Contribution plan. Can somebody tell me how provident fund is administered by the company? So they make the payment. There are two ways in which you can do it.
Company will make a contribution to the PF commissioner.
PF commissioner is one.
At the time of retirement, commissioner rate they will settle the part with the employees.
There's other way.
Other way, the employee will make his own trust.
Trust.
They will form the EB employees PF trust.
Okay.
Where the employer they maintain the fund.
How many of your auditors have companies under your audit where they go through this trust route, PF trust route? So many places they make it to directly to the commissioner. So do you have companies under your audit, under your watch list, where the company has a trust, PF trust, where normally one employee will be a trustee or employer will be a trustee, and they manage their own investments? Do you have anything like that? Any place? You don't have? None of you have? Okay. So if you have that case, then it is not a contribution plan. It is a benefit plan. Because the trust deed will say that in case there is a shortfall, the company has to make good the shortfall. And if this particular clause is not there, the income tax authority will not stamp the trust for your 43B benefit. So that particular clause is there in the trust deed. The moment the trust deed has this clause, it becomes the risk is with the company. It is not given to the employee. Therefore, it becomes a defined benefit plan. That's what it says here. Where in terms of any plan, the enterprise obligation to provide the agreed benefit and former employees and the actual risk, the benefits will cost more than expected, the investment risk falls on the enterprise, the plan will be a defined benefit plan. Accordingly, provident fund set up as employers which require interest shortfall to be met by the employer, it will come under, I have quoted the old AS 15, paragraph 26B, but the new Ind AS 19 also has a similar paragraph. So this is the particular conclusion in this aspect. In those cases, the implication is a fair valuation of the PF trust assets have to be made. Because it becomes a defined benefit plan, the trust fair value has to be done. This is what is there in a particular notes and accounts of a particular company. It says that the exempted trust fund is doing the valuation and disclosing it as a defined benefit plan. So this is a extract from a particular company. Here I am saying the cost, the second paragraph, the cost of providing benefits under the above defined benefit plan is determined using the projected unit credit method with actual valuation being carried out at each balance sheet date, which recognize each period of service, giving rise to the additional unit of employee benefit entitlement. They are given this for the provident fund itself. This is taken out from a particular company, which is basically Bharat Forge Limited. I mean 2-3 years old, but it is there. So coming to this, why do we need actual valuation? From gratuity aspects, one is for compliance. Accounting standard says you have to do a projected unit method, PUC method, so you have to do an actual valuation. And you have to assess the level of assets which are there. If it is funded, you have to, the actual valuation also gives you not only the gross liability, it also gives you the assets. And therefore the difference between the liability and assets will be the shortfall or excess payment to the fund. So to assess the value of the the particular assets also, you have to do an actual valuation, and based on that the contributions are also decided. Sometimes you have a merger or acquisition where employees are also part of the merger acquisition. In those cases, actual valuation will have to be made. There is a particular aspect in actual valuations that it is done on a going concern basis or it is done on a non-going concern basis also. you look at the actuary's report, it will say that I'm doing it on a going concern basis. But when you want to do it for a demerger, specifically for the demerged entity, one particular undertaking, you may have to tell the actuary, do not do it on a going concern basis. He will do it on the other assumption, and the liability may increase also. That is something you have to keep in mind. Liability settlement for discontinuance of operations also, actuarial valuation is used. So how an actuarial valuation is done? So you calculate basically the present value of the payments. So what do? They take the salary increment rate, as we mentioned earlier. We said that after 10 years, how do we look at it? So we have to look at different aspects. What are the different aspects? One is attrition rates. Employee may leave. Instead of waiting till he is 60, he may leave in the middle of the period also. In software companies, attrition rates are very high. That means you may have to make a payout not after 40 years, but after maybe 10 years itself. That is one aspect. Attrition rate is very high. If you go to leave within 5 years, then no gratuity is to be paid. So attrition rate can work both ways. Salary escalation rate is there. Then you have a discounting factor in terms of the present value of the money. So different factors are used, which is given here, to do the actual valuation. Now, whose responsibility is it to do the actual valuation? What is the role that auditor has in the actual valuation? Can I have some discussion from the audience here? What do you feel as an auditor? Are you responsible for the gratuity actual valuation? What do you actually do?
The inputs given by the company, normally we will check.
Input given by the company?
To the actual.
To the actual. So what are the inputs, sir?
Normally the number of employees, staff cost, increment, balance period of employment.
Oh. All those things we are checking. I want to take this to different files, not moving there. Give me a minute, please. Yeah, we're discussing on this. So you're talking about the data of the employees, which has to be looked into. What about the assumptions, sir? What about the assumptions? Should we look at the assumptions? So what could be the different types of assumptions? Okay, we'll park it for a moment. Just get back to go into this. This is another slide on, though the topic today is Ind AS 19, I just touched upon accounting standard, the old company accounting standard rules, where it talks about whether an SMC or a non-SMC. If you are not a small and medium company, you have to do full actual valuation under the projected unit credit method and do the full thing, just like Ind AS 19. If you are a SMC, if you have more than 50 employees, you have to do a valuation, and not detailed disclosures are not required. Some disclosures are required. If you are up to 50 employees, you can even do a different type of quick arithmetic method and all those things. So these are all things which are there in the old standard. I'm just touching upon it quickly. And this is what I was saying. So AS 15 to Ind AS, you have a situation where AS 15 para 50 it says the detailed actual valuation of the present value of defined benefit obligation, that is actual valuation, may be made at intervals not exceeding 3 years. This is what is there in the old standard. So before Ind AS, if you are an auditor of a company, the CFO comes and tells you, sir, I have done actual valuation last year, I will not do it this year, will you accept it? We have not accepted it. We are saying actual valuation is done every year. But he could have brought out this particular paragraph and stumped us. So it is there, already there in the standard. But this particular thing has moved out. We have progressed now to saying that in Ind AS 19 para 59, it says involve a qualified actuary. Now who does the actual valuation in practical sense in the companies that we audit? Where do we get the actual report, sir? LIC?
Actually, they will give it.
Sorry?
From the actually.
Actually. Now, how many of us look into the LIC? Because most of them fund it with LIC. LIC gives a report. How many of us take that report and utilize it for accounting and disclosure? Nobody uses that? So, do we have a LIC report, sir, in your defined benefit plan gratuity?
Normally in gratuity cases, wherever we can contribute towards the
Contributions with LIC, right?
premium.
Premium. So, they give a report every year and they give a report.
Yeah, they say what is to be contributed.
Ah.
We'll give you a report, so and so has retired and such date, we'll send a report to them. LIC will directly send the money to those respective employees.
Ah.
That is how LIC is doing.
Okay. But behind that, there's no report?
No, they are getting a report after.
No report.
Opening contribution during the year, then only come.
They do that, okay. Actually, so if you look at it, LIC gives an actual report. They give some sort of actual report which may not be fully there, but most of you do not rely on that.
Disclaimer. LIC gives you a specific disclaimer.
Ah.
It is not an actuary.
Okay.
Sir, every report, every certificate has a disclaimer.
Okay.
LIC gives you a disclaimer.
Okay, fine, sir. Okay, we'll come back to that. You are all familiar with this?
I just want to
Yes,
ask the partial answer to the question you raised about what do you give to the actuary.
Yes, sir.
Assumptions also. In fact, from paragraph 7 onwards,
Ah.
it talks about the assumptions. An entity shall give the assumptions.
Entity shall give assumptions.
Yes.
Okay, fine. We'll just come to that. I just parked it for a
Oh, I'm
moment.
sorry.
Just,
I'm sorry, apologies.
So we have this particular place here where we look into the. Or is everybody? Can you see from there? Is it okay? Is it no? Okay. So we have something called the defined benefit obligations. This first part over here, defined benefit obligation, which is the gross liability. The movement is there. Then you have the fair value of plan asset. Asset movement is there, and then the expenses recognized in the profit and loss account. So these are the three major tables which are there in the disclosure, and this is given by the actuary. So when I looked at it 10 years back, I couldn't make head or tail out of it. So is somebody relating to that scenario? Sometimes we will not be able to make head or tail out of it. We just see the numbers. There is some gross liability, gross asset. Difference between ensure that it is provided for the books of accounts, and whatever the actuary has given, we just copy it in the notes and accounts. That is what we do. So the purpose of today's thing is for next 20-25 minutes is to unravel this a bit, not to give expert opinion on anything, but only to touch upon certain things, so that we know that there are some things that we need to read. Then we can go back and go through it and become experts. So that is the objective that I am going to have in the next half an hour or so. So if you look at it, there are other things like, if you take the movement of defined benefit obligation, it starts with the opening balance. Then it talks about interest cost, current service cost, past service cost. So obviously all those costs will be added to the opening liability. Then it talks about benefits paid, which is obviously reducing the liability. Then you have something called actual gains or losses, which may be plus or minus because it is gains or losses. And then the closing balance. So the gross liability movement is very simple. The changes in fair value of plan assets is also there. That is also starting with the opening fair value of plan assets, then interest income, contributions which come from the company. This is basically the gross liability of all the employees of the company, and the money that is there in the trust fund or wherever it is. The difference between those two, the gross liability is more by 50,000, then the trust needs 50,000 from the company, so it will show it as a receivable, the company will show it as a payable. That is all it is about. So the plan assets movement is there, opening, then interest income, for the assets interest income will come, then the contributions which will again add up to the assets, benefits paid which will go out. So benefits paid is there in both liability movement and asset movement, And that is very easy to audit also. We'll have to do the audit of benefits paid. Employees have left the company, that's all. Then actual gains or losses for assets also it is there. Then closing balance. Then if you look at the amount recognized in balance sheet, defined benefit obligation at the end of the year, that is the gross value. Fair value of plan asset at the end of the year, again that gross value. Difference between those two, net liability or asset recognized in the balance sheet. If it is a liability, we have to recognize it. If it is an asset, should we recognize it? We should recognize it also. There is something called asset ceiling. There is something called asset ceiling. So supposing it's like a prepaid, it is called surplus. It can be taken as a prepaid and shown in the balance sheet. Only then your balance sheet will tally because you have funded more. This though it may not be receivable back, there is something called asset ceiling concept in IAS 19. Kindly have a look at it. I'm not explaining here because I read it, I could not understand fully. If you can give me some pointers, that would be good, sir. Maybe we'll have some.
I think asset ceiling is that I think you have to take a lower amount actually.
Yeah.
There are two amounts. One is the amount of liability, excess of excess or liability, and I think there is also the question of the point about trust being irrevocable, whether it will result in a future contributions being saved.
Exactly.
In other words, you cannot get whatever you have paid as an excess because the irrevocability of the trust is involved.
Correct.
But what you can take credit for is what will be saved in future by not paying.
Okay.
I think that's one of the
okay. We'll come to that because there's something called past service cost where there's a linkage. I will explain past service cost a little later and then come back to this asset ceiling. But basic concept is if there is extra assets, you can account for that as a prepaid or a surplus in your balance sheet, just like you account for a liability. Then you have something called the expenses in the P&L account and OCI. For a moment, let us take everything in P&L account only. You have current service cost, past service cost, interest income. All these four amounts which add up plus and minus and come to the P&L total, all these four line items are there in the first or second table movement only. Same amount should be there. So that is the rule of thumb approach that we have. So you see the movement of gross assets, see the movement of liability and then assets, and then look at it. From a very layman's perspective, when I look at the actuarial valuation, I will see what is the increase in the gross liability. What was the increase in gross liability last year? That something called current service cost is current. So 1 year is over. So 1 more year of gratuity for everybody have to pay at 15 days basic or whatever it is. So that is the increase that we are talking about. Has it increased correctly? Many people have left, benefits paid would have been there. So you can understand the movement in a logical manner. Just see and look at it, you will understand certain things. So similarly, assets also we will be able to understand. So this is how we need to look at it. There are other disclosures also which are
The
there.
asset addition is what the premium we pay.
Sorry, sir?
This asset addition is what the premium we pay.
No, we don't recognize those movements.
No.
in the
Premium,
books.
yeah, contributions is something that the premium that you pay. Contributions.
Asset addition is what they invest for us.
No, asset addition when you say, the assets move because of contributions, which is you pay to the fund. Interest will also earn, no? That will also increase. Benefits paid will decrease. Benefit paid will decrease the asset, will decrease the liability also, same way. That is an auditable amount. Contribution is auditable easily. Movement from company to fund, auditable. Benefit paid, auditable. Others only will have to quickly run about and see current service cost, past service cost and all those things and see. Many places past service cost should not be there unless the definition of past service cost is clicked. We come to that a little bit later. Now, the important terms in gratuity. So when we talk about the present value of defined benefit obligation, we talk about the gross DBO, defined benefit obligation, DBO, at the gross level and not at the net level. It says that without deducting any plan assets of expected future payments required to settle obligation. That means if you have 150 employees, over a period of time, how much you have to pay them. As of today, what is the liability? Liability will keep on increasing as we go by. It will increase because of salary increases. It may not increase because some of them have attrition of high attrition. They will not even last 5 years. Then payment of gratuity act is not clicked. You don't have to pay them gratuity. So with all these factors, what is the amount? So that is what is defined benefit obligation at the gross level. Then you have the current service cost, which is the increase in present value of defined benefit obligation resulting from employee service in the current period. That is, you had an opening balance of DBO. During the 1 year, extra charge is there to the gratuity. 15 days basic number of employees. That is current service cost. Let us keep it that way in a very simple manner. Then interest cost is there, which is the present value of the interest is the increase during the period in the present value of a defined benefit obligation, which arises because benefits are one period closer to settlement. So DBO, the overall liability is there. At some point you have to pay. That God knows when that is there. Let us say it is 20 years later. When 1 year was over, from 20 you become 19. You are stepping closer to that. To that extent, the interest cost is there. That's why they say interest cost is computed by multiplying the discount rate. What we take for present valuing, the discount rate assumptions, so I mentioned that also. That is taken here and multiplied by the DBO, the interest cost is computed. This is what the actuary does. It is enough if you know this much, and with the discount rate, put the percentage of discount rate with the opening DBO and see what is the interest cost. Is it coming closer to that? Overall reasonableness test, if we do, that is enough. So I will stop here because more we can get into it when we dig deeper, but today is not the day for that. Plan assets. Assets held by a long-term employee benefit fund, and it could also be qualifying insurance policies. You could also take insurance policies. It should be legally separate from the reporting enterprise and exist solely to pay or fund the employee benefits. Both long-term employee benefit fund and qualifying insurance policies are defined in Ind AS itself. How many of us have done central statutory of banks in this audience? I suspect there are some banks where, I'm just saying from my general knowledge, where they have a defined gratuity fund. The money goes to the fund, the trustees are there for the trust fund, and they put deposits. If you look into this last line, composition of plan assets, insurer managed funds with scheduled bank. So even a gratuity fund of a bank will keep the money in the bank. So is that money a plan asset? If it is in some other bank, it is a plan asset. If it is the same bank, it is not a plan asset. Why this definition has come? This definition has come because of basic logic, common sense and social aspect. Entire amount of keeping the money outside separately is, even if the company crumples, that money is available for the employees. If that particular thing again puts it back from the locker, back into your house itself, to the bureau, somebody can come and take it. So it is not a plan asset. So this aspect is very, very important in the definition of plan asset. So in those cases, it will not be a plan asset at all. The liability will increase. So qualifying insurance policy, assets, these are same type of definition which says that, basically it says they are held by an entity that is legally separate. It exists solely to make the payment. It is available only to pay the employee benefits. It is not available to the reporting entity's own creditors. So that it is kept aside. It is a one-way street. However, unless, second part, the assets are returned to the reporting entity to reimburse it for employee benefits already paid. Sometimes an employee leaves, you have to give him the gratuity. Strictly speaking, you have to give it to him from the trust only. Some urgent requirement, you make the payment from the own company itself and make the payment. What do you do? It says that to that extent you can get it reimbursed. It is still plan assets. Sometimes when they make the payment to the person who leaves, they may take it as a contribution and then they take it as a payout. So that particular aspect is still allowed. It is still allowed that if you make a payment from the entity itself, reporting entity, the money which is outside can come back and reimburse that amount. Still it is called a plan asset. So actual gains or losses, what it is, the definition says they are experience adjustments and changes in actual assumptions. So experience adjustment, actual adjustment. We'll come back to this because we have to go to the assumptions and then only get into this. Past service cost. The past service cost is a change in the present value of defined benefit obligation for employee service in prior period, resulting in the current period from the introduction of changes to the post-employment benefit. We had 2 years back, we had something where the asset cap was increased from 10 lakhs to 20 lakhs, right? The cap for gratuity was increased. Because of that, some people, their liability in companies increased. That increase in liability is basically a past service cost. So this is, once the cap has increased, somebody who is getting today 15 lakhs of gratuity would have been capped at 10 lakhs as per the policy of the company. Once his cap has moved from 10 lakhs to 20 lakhs, immediately you have to make the provision of 5 lakhs for him, which you would have made, he would have reached 10 lakhs on the 7th year itself. Today is 12th year. So from 7th year to 12th year, every year 1 more lakh he got, but you would have capped it at 10 lakhs and not provided for him on 8, 9, 10, 11, 12th year. Now 13th year you open it up, you increase the cap from 10 to 20, all those 7, 8, 9, 10, 11 years of 1 lakh each, you have to make a provision in the 13th year. It is not a prior period item, but it is called past service cost in the actuarial terms. So when you look at the past service cost, the liability movement, that will come in past service cost. The clue from that is, normally past service cost should not be there in the movement of actuarial report. When you see the actuarial report, past service cost should not be there. If it is there, you need to ask the actuary why it is there. It's as simple as that. So this is an example of past service cost. I will quickly explain this. The first column is the present value of obligation is 10 lakhs. Because of the 20 lakhs limit, the present value of obligation has gone to 15 lakhs, an increase of 5 lakhs which is given in the third column. This year suddenly 5 lakhs it has to go up. This is on account of some employees who have finished the vesting. 5 years is the vesting period for gratuity eligibility. So what we found is for some employees who have already finished cross 5 years, this extra 5 lakhs, those employees are 4 lakhs is the amount. And for some employees who are still within that 5 years, they have finished only say 3 years. For them it is 1 lakh. The total amount of increase of past service cost is 5 lakhs. So it is divided into 2. So out of the total past service cost of 5 lakhs, past service cost of rupees 4 lakhs is arising in respect of employees with past service of 5 years or more. And it should be recognized as an expense immediately. Whereas that balance 1 lakh is for employees who have finished only say 3 years. They have 2 more years to go. That 1 lakh will be provided at the rate of 50,000 in year 1, next year 2 50,000. So in the current year you may only provide 50,000 rupees. The second balance of 50,000 which is there, which is not provided for, is part of the asset shielding that Mr. Kumar mentioned. Supposing you have over provided by making funding, you cannot get it back to the extent of this unprovided past service cost. So unprovided past service cost has to be reduced from the asset ceiling if you have a surplus. This is a very fine tuning aspect, but I just thought I'll touch upon that particular concept also.
They used to have this what's called the corridor effect.
Yes, corridor effect was there.
That was removed actually.
That has been removed now. So this was there earlier, but now it has been removed. So this is the concept of past service cost which was there now. In the India also it is removed. So now, I think now the entire 5 lakhs has to be provided for. Okay, I stand corrected over that. Thank you.
I think so. I'm sorry. I'm not trying to second
No,
guess or
it's
anything.
good.
But there was a corridor effect that was subsequently amended in IFRS also.
IFRS.
And also
Correct. That's true.
I don't know with reference to this. I'm not sure.
Okay. So this is something which has now got superseded. So the entire 5 lakhs has to be provided for.
I'm sorry. I wasn't trying to correct you or anything. I said I'm sorry. I wasn't trying to correct you.
No. It's very important because this is only a discussion, and we should give the right message to everybody else also. So
Because I'm not sure with respect in context of this. I'm not sure.
Okay.
But I'm making a general observation.
Okay.
That the corridor effect was withdrawn.
Corridor effect. Okay. Fine. So what are actual gains and losses? So actual gains and losses, we got a definition here which talked about experience adjustments and then effect of changes in actual assumptions. Now, Supposing you say that salary escalation is 5%, and then you have, for the current year you actually give 10% increase. At the end of the year, what happens? You get a more increase in the gratuity. So your budget is 5%, but actual is 10%. The difference between actual and budget is the experience adjustment in very simple language. So that is what is called about actual gains and losses over there. So it says that this actual gains and losses will happen both for liabilities, gross liabilities, as far as for the gross assets. Both places it is taken, because these factors will affect both the liability and the asset. This is what an actuary will done. If there are a lot of actual gains or losses in the actuary's report, then we need to look into it and find out, then is it because of a change in assumption? Then fine. But if it's a correction, do we have to correct an assumption? So consistently keep giving 5% as a salary increment as an assumption, but actually you give 8% or 10% salary increase, that 3% or 5% change will always come in actual gains or losses. Then if there is a high amount of value in the actual gains or losses row item, we have to immediately call up the actuary, understand that, and attack the root cause. If the assumptions are not correct, make a calibration change over there. Then the actual gains and losses would come down the next year. That is something that we need to keep in mind. And this actual gains and losses in India's scenario for gratuity will go to OCI. It will not come to P&L, it will go to other comprehensive income. So this is what is basically the thing. So now we come to the assumptions. So assumptions can be discount rate, salary escalation rate, which are both financial assumptions, and could be attrition rate and mortality rate, which are both demographic assumptions. It could also be broken down into salary escalation rate and attrition rate, which are internal factors, and discount rate and mortality rate, which are external factors. When I say internal factors, salary escalation and attrition rate, it is specific to the company. Whereas discount rate is based on government bonds or whatever you say, it is common. If you do a gratuity for one company A, for company B also discount rate should be same for the same period. Whereas the salary escalation rate, attrition rate will differ from company to company. Mortality rate also is same. LIC takes a very old ancient mortality rate. Nowadays there are mortality tables which actuaries take, which is more closer to reality. So therein there could be difference between the LIC report and the actuaries report. We discussed this already. So this impact of 20 lakhs also has been discussed. But main thing I want to convey here is, when you do an actual valuation for gratuity, we have to ask the company, do they have a cap or not? Cap has been increased from 10 lakhs to 20 lakhs, that's fine. But does the company have a cap at all in the first instance? What does the policy say? Some companies need not have a cap. They can say any amount is payable to the employee. Just like the leave policy when we talked about, you have to ask what is the accumulated non-accumulation, how much they can carry forward. Similarly, a question that the auditor has to ask the company is, do you have a cap or not? If you have a cap, what is the amount? If you don't have a cap, also, where is it recorded in the minutes? Somewhere it has to be recorded. It is a very important estimate. It could be a fact, but sometimes it's an estimate, because company may not know. The CFO will say, I think I don't have a cap. If companies do not have a cap, the 10 to 20 that changed last year or something will not impact them at all. There is no past service cost, nothing. If they had a cap, they would have had a past service cost. So this is something that we need to take a call on that. So this is all the same thing. So using the work of an expert, this is what we were discussing at that time. We have to look at the rate of return, number of employees, retirement age, salaries, promotion policies, age of employees, all these things have to be looked into. Are LIC gratuity reports sufficient? I am happy to hear that none of us are relying on LIC reports. There have been a lot of cases where we have only relied on LIC for the liability portion itself. Now, if we are only relying on LIC report only for mere contribution, it is good. It's better to have a separate actuary doing the gross liability computation and doing it. Practically, there could be situations where a different actuary is doing the valuation maybe next year, or we are switched over from LIC to an actuary. Earlier we were only relying on LIC. We have to ensure that the new actuary, when he does it, he takes off from where it has been left last time. If the gross liability has left a particular amount, he should take it from there. Many times what they do is they do their own computation. What you do for a gross liability and my gross liability may change slightly, maybe at the same level. It's important to tell them to start at the same amount and then carry forward. Otherwise, the entire thing is changing for 2 years, then it's only an estimate ultimately. It's an expert's opinion. Then you may have to go back to change last year, put same notes. The practical aspect, you have to take care of this aspect in case your actuary changes. That's important. Why LIC is not important? As Mr. Nagaraj mentioned, the report mentioned that above report is not a certification under AS 15 read with Actuaries Act. They give a disclaimer. So wherever LIC is being used, we should not rely on that. We should ask for an independent actuarial valuation. This is again something which I picked up from an actuarial firm's website. So what they say is a 4-way test. We have the 4-way test in Rotary. Okay, this is a different 4-way test. I'm not in Rotary, but still. Data quality. So ensure that data quality, accuracy, completeness, and consistency over the period of time. That is very important. Appropriateness of assumptions is very, very, very critical. Then the liability and expenses movement analysis. As I told you, just have a look at the movement, how it is moving. Is it okay? Suddenly the gross liability should not increase. Asset also should not increase. Look at the actual gains or losses. Is it coming in? There should not be past service costs unless it warrants the situation. What is the actual rate of return? That is income that is coming compared to last year. Why there is an increase or decrease? All these things you can have a call with the actuary also. Have a call or meet him along with the company. Understand this better. I think it will help us to ensure that it is more. Even the actuary will wake up. He'll say, okay, yes, these people are asking questions, so he may be also the sharing of information always better for us. Employee-wise liability workings. So there's one thing which I told earlier itself, related parties to be given for the first 3 things, short term, other long term. If you have noticed, many companies, related parties for the MD, for the key management personnel, they give a note. This does not include the cost of contribution to gratuity or something like that. Some places they include that also. So strictly speaking, contribution made for gratuity where the managing director is involved, it should be coming as part of the KMP in related party disclosure. If you are not able to get a granular level details from the actuary, you will not be able to provide that information. So you provide a note saying that I have not provided that, I have not disclosed it. If you are able to get it, you include it also as part of the particular place. So if you are having a situation where you are not getting granular data and not putting that note, again FRRB can come and comment on it. So you have to be very careful over there. Better to get the granular level data. And then, so data quality, assumptions, look into the movement and all those things, and appropriateness of disclosures. Disclosures are very, very important. 95% of the cases, disclosures are not given properly. So FRRB mentions a lot of things where the disclosures are not given properly. So we need to take care of those aspects.
Post VRS payments, is there a relationship between future contributions to gratuity and is there a discernible trend after VRS payments? Does the contribution to gratuity increase or decrease, or is there a discernible trend?
After VRS?
After VRS. Is there a relationship?
It will actually increase.
Invariably, definitely.
Invariably it increases.
Now, I'm talking from an audit point of view.
Yes.
Next year, when you go for a post VRS, after VRS,
it will increase.
So you should always have as a rule of thumb that the gratuity payment should increase.
Yes, it should increase. It should increase. Because the reason being, we are actually anticipating the payout later on. Sudden payouts are there. The interest income portion, all those things get situated. I will also reserve this question and ask the same to an actuary and get an answer.
See, when VRS happens, the future liability reduces.
Correct, sir.
See, if somebody is retiring at the end of 15th year, instead of providing for 25 years, we need not have to make any provision for the balance 10 years.
Correct.
So the future liability will not increase.
That is also there, correct. There is also a correlation between discount rate and some other rate also. I'll come to that a bit later. I have something on that slides.
I could never figure it out actually. I always thought about it because when you're doing an analytical review, balance sheet audit and so on, there's always
always an extra funding that is required.
So I now could figure it out actually.
Correct. It again depends on the inflation factor, discount rate, and the salary increment rate. So I think it's interplay between the salary rate, increment rate, and the discount rate. So I have something on that. Maybe that may partially answer your question. So this is what it says. So the data quality, you torture the data, you look into it more, it may confess, it may come out with some issues, which may help you enhance the quality of the computations. Assumptions have to be looked into, because if assumptions are garbage in, garbage out, what you see is what you get. So that's very important. Qualitative and quantitative disclosures have to be taken care of. Why should you ask for employer's liability? So you can do spot checks, because many places this is not asked for at all, and you will immediately get a resistance, a block. The CFO will say, sir, this is not done, this has not been done last year. Okay, you start asking for it. If not the current year, at least next year you can start getting it. Even actuaries are not used to being questioned by the CFOs or by the auditors. So this is something that we can definitely ask, because he is not getting the amount from thin air. As you rightly said, the data is given to the actuary and he builds up based on the database. He will have employee-wise details, and total is what he is giving in the summary in the report, the actual report. So granular data is available. If you get granular data for 2-3 years and do some comparisons, you can come out with some findings, like especially for senior people. So you have places where more seniors are moving out in the next 3 years' time. As Mr. Kumar mentioned, if the payouts are there suddenly, it's not only VRS, it could be planned separation. State Bank of India had a lot of people who were very senior people, suddenly they left. It had an impact on their cost, employee costs. So there is some correlation, so we can understand that, and if you take all these things to the management, to the managing director or something, they will see value in what we do. So this is a place where we can strike the right chord over there.
Actually, the PF, you are supposed to maintain a separate folio for each employee.
Yes.
Because employer's contribution, employer's contribution, and then interest computations on each of the. So it's a statutory obligation to maintain a separate folio for each employee.
Yes.
PF.
Yes.
But not, is it all
No,
something in
it is not there. It is not there in gratuity.
Yeah, that's probably why you won't get the information.
It is only a pool, but actuaries do have it. So because they work out from a granular level and give you a summary, you can definitely get that and utilize it.
Sir, have you come across any situation where the LIC or the funder has rejected gratuity because of wrong providing of information?
Not providing
correct information.
I have not come across it. First of all, how will they know it is not correct information? What you provide, they'll do it. They put a disclaimer, this is what we are calling.
No. When suppose a person retires or resigns, right? They have to pay gratuity. Then they come across that the information provided while doing the insurance premium calculation is wrong. Okay. Do they have a right to reject?
You are asking about LIC?
Yes.
I don't think they can reject. See, it's a question of funding. You might have underfunded because of the wrong data. Underfunding is okay, but under provisioning is not okay. So you have to distinguish between that. I don't think it should be a major issue. Though it is an issue, it cannot be a major issue to reject or anything like that. So granular level data, we need to look into it. Better to ask for it. sensitive assumptions, salary growth rate, discount rate, they are very sensitive. There are companies where you have something called sensitivity analysis, which is coming as part of disclosures. For every change in percentage, 1%, what is the impact on the liability? I have certain clients where 1% change in your salary escalation will change the defined benefit obligation by 10 lakhs, 15 lakhs. There are some companies where the 1% change may result in 10 crores. If the company is a large company, 1% change, you take Infosys or you take any of those large companies that we have, 1% change or 0.5% change will run into crores of amount. So the sensitivity analysis is there. That gives us an extra responsibility when you see that these assumptions have to be really looked into carefully. I remember that Ms. Bhavani Balasubramaniam, Fraser and Russ, she was talking here. She said in their documentation, she was saying they document if the salary escalation is 7%, they not only justify the documentation of why it is 7%, she also documents why it is not 6.5% and why it is not 7.5%. They also document that, it seems. When they document something like that, they really reflect on why it is not it is. And the seriousness is also given to the client. So that is the impact of sensitiveness of these assumptions. And the sad reality is that sometimes these assumptions are given a big go by auditors and by the company. And actually take some, as I told you earlier, there are two things which are general, discount rate and mortality rate. Salary rate and salary escalation rate and attrition rate are company specific. If the CFOs do not give the correct data to the actuary, they take an industry rate, they put an asterisk mark and say this as per industry rate because data are provided or something like that, and do it. It may change the entire numbers, the financial statements of the company. So it's very, very important and critical to look into the assumptions that are going into the actual valuation. So it could be like you can have, there is one company where they are not doing well. So they came to me and said, sir, is there any way where you can reduce the gratuity liability? I said, yeah, I can do it. Instead of saying 100 employees, you put 50 employees, you can reduce it. But that's not on. And we started thinking how we can do it. Then we found it is a IT enabled service sector where they have a lot of programmers, which are like 5,000 to 10,000 employees. Then 500 employees only in that top management. We found that the attrition rate for this 5,000 employees, though they are all low cost employees, this 500 only were high cost, but for this full segment, attrition rate was as high as 25% in the last 10 years. So we took that attrition rate, I don't have it here. For that, we broke up the entire population into two. This particular thing, attrition rate 25%. The above thing, attrition rate 2%. Earlier they had attrition rate 8% or something like that. We broke it into fully like this. Because of the change in assumptions, it will go on actual gains or losses. That earlier definition I told you. There is a change in assumptions, it will go on actual gains or losses. But that time we didn't have OCA and all those things. So it reduced the liability. And it was a true thing also. It was something which was really reflecting what is happening. So you can have salary escalation rate also for a new company. It could be very high, startup company. After some time it will stabilize. You have new age manufacturing companies or IT enabled companies, salary escalation will be high. Similarly, the age profile of the employees are also sometimes taken as bandwidths for assumptions. So from this angle, if you look at various companies Ind AS 19 disclosures, you may find various ways in which they do this particular aspects. So salary growth rate, we have to, the theory is, it takes into account inflation, seniority, promotion, other relevant factors. So let's say seniority age-wise can be taken. And this particular sentence is not only the theory of salary growth rate, we have to give it in the disclosure also. Even in old AS 15, at the end of the table, this particular sentence should normally come. Many times it is missing, but it should come. It should continue to come in Ind AS 19 also, the disclosures. And it is ultimately the responsibility as well as the right of the management of the reporting enterprise to determine the assumptions to be used in the valuation. The role of actuary is only to advise. The sole responsibility, primary responsibility, company. Advisor, actuary. The auditor, he has to check. He can advise, but he has to check and monitor. So the salary escalation rate can be divided into three: productivity component, merit component, inflation component. I'm aiming to close by 8:15 maximum, so I will skip a few things quickly. So you have different components on this. There is one website called KPAC, actuaries. A lot of actuarial websites which are there. I'm specifically saying, though it's there on the internet, simple. KPAC. In their website, they have a lot of technical literature which is very useful. So you have salary growth rate in Dr. Reddy's lab, 11% for first 2 years and 10% thereafter. You have in Asian Paints, management, they are again divided into management, non-management, and then given. Okay, now the question is, should salary escalation rate of gratuity assumption be same as compensated absences? You have compensated absences, right? There also actual valuation can happen. There also salary escalation rate will be there. Here also salary escalation rate is there. Should both these amounts be same? Many companies they give that, but other long-term places they don't have to give all the disclosures like gratuity. But many people do give the disclosures. If they give the disclosure, we'll see that salary escalation rate is sometimes in one place 5% for leave, 7% for gratuity. We all say it should be same. Should it be same? It is same in most of the companies. If 99%, 1% if it is not same, it is because of an error. But theoretically speaking, it could be different.
But we have to give the reasons for the difference.
It's simple, sir. For gratuity, what is the components?
Notes.
Not required, not required.
Yes.
Because we don't have to justify everything as long as it's factual. For salary, as I told you, the costs are different. In one place, utilization, you take the entire cost of this employee. Basic, DA, HRA, even employer's contribution to PF, everything is taken. And for encashment, as per the policy, only basic and DA may be taken. So when you do a mix of, the salary escalation rate may change over there, because this if you give a person a salary increment of 15% in a particular year, you may give out of the 15% so much in basic, others you may go to other allowances. So for leave, the entire, if it is only utilized leave, not encashed leave, the entire 15% may come as a salary increment. Whereas for gratuity, only the basic component has to be taken, basic and DA. So the salary escalation, there are two things I want to say.
Quantum may change, but percentage should not change.
It could
Quantum
change.
may change based on your structure.
Ah,
Quantum may change,
Sir.
but rate won't change.
No, rate will change, sir, because the rate of, let's say 15, if I give salary increment to you for 15%, in that increment, only 2% goes to basic. Balance increment goes to others. 15% I give you, sir, 15 rupees. From 100 becomes 115. Basic, let us have a breakdown. In that 15 rupees, I give only 1 rupee as increase in basic. Balance 14 I given other allowances. So basic, the increment will be 1% or something only. Whereas it will be 25% in other allowances. Then when you look at the salary increment for the purpose of gratuity, it is only 1%. Correct me if I am wrong. Whereas for leave, it is different. So we also have to ensure, when we ask a company for gratuity, actual values in general, when we say 11%, 10%, it is not what they give a full increase. The HR will put an increase and say 11% increase overall. What component determines this gratuity? That increase only we have to take. This is something which is not there in any other theoretical books. But I have my own views on this on a practical aspect. And I would like to be corrected if there are any other views on this also. Discount rate is another very, very important thing. So it is a post-employment benefit application. The rate used is reference to market yields. the currency and term of the government bond shall be consistent with the estimated term of post-employment benefit. For example, you have this from 1 year to 30 year, you have a scale. Today itself, if you go to any of the actuarial website or you can get this from internet. So yield on government bonds on September 18, for a 1 year bond it is 7.9, for 30 years it is 8.42. So your discount rate has to be anything between 7.9 to 8.42. And the discount rate should be same for all your companies. Normally, that's what I said earlier. But if you have a company where all the people are 57 years old, majority of them, they are going to retire 58 or 60, then you will take the first three, 8.12, around that level you will be taking. If it is a younger company, startup company, you may even go to 8.42. So, though it is an external rate, discount rate, more or less it should be same across companies. There could be changes because we are supposed to take, as per the definition, it should be consistent with the estimated term of post-employment benefit obligations. When it is going to make a payout, what time you are going to make a payout, that needs to be looked into. This is something which is there in theory. In practice, how much we are observing, we don't know. Many places, the discount rate is not even between 7.9 and 8.42. In many places we see that. It is something different. So, this is another place where an auditor has to check the assumptions, whether the CFO gives it to the actuary or the actuary himself decides. Whoever does it, it is up to us to ensure that this theory is taken care of carefully. It is very, very important. So, you can take a single weighted discount rate. This is what is the guidance given. So, this is again why you should take market yields. So, many people ask, should I take my borrowing cost? After all, it is net present value. Should I take my borrowing cost and do it? Why should I take market yield of government? So, the answer is the second bullet point. Discount rate reflects the time value of money. It does not reflect the company's own credit rating. Based on our credit rating, our borrowing cost is there. So, this is the theoretical answer again over here. Attrition rate. This is the most difficult assumption because it has different types of factors to it. Practically, it could have different types. Geographical, industry-wise, pay scale of a particular. Attrition rates are higher in middle places or lower places. It could be very less in higher salaried people. Depends on a demographic trend. So again, this has to be taken care of. This is the thing which may be answering your question on that VRS. It says that the theory is that the longer the payout period, lower will be the liability, the salary growth rate assumption is lower than the discount rate. So this is a theory which is there. This is a proven theory. So when you break this, the period, obviously the numbers will change. You have a VRS which suddenly comes up. You suddenly decide that you want to hive off so many people, or you say you want to demerge a company and then fund the gratuity also to the demerged company. Then there will be disruption in the P&L account, funding and all those things because of this particular theory. This is again there in that particular website, KPAC. I'm not getting into it too much. So control points on gratuity. Are the direct payments by the employers, part settlements, how do you look into it? Expenses of the fund, how it is taken care of. Expense of fund is supposed to be also funded by the company. Assumption setting, large actual gains or losses, if it is there, actual gains or losses more than 10%, please inquire with the actuary. So, accounting standard employee benefits prescribes management's responsibility to set assumptions. But it is the onus of the auditor to express an opinion on annual accounts and which should reflect a true and fair view. It is our responsibility also. Therefore, they also play a major role in setting assumptions. A discussion between three parties is very important. That is the conclusion that we need to look into and carry home with us. So the data, actually will check the data, the management will provide the data, auditor will check the data. Assumptions will be decided by the management. It will be Actuary can give a consultative role of advising them, but it should be concurred to by the auditor. Ultimately, we have to concur to it because it's a role. Management will rely on the results which have been provided by the actuary, and auditor can rely on the results again, provided that all the assumptions, everything is taken care of. Disclosures again, actuary will provide for it, and based on that, they have to disclose, and the auditor should concur. Not all disclosures will come from the actuary. There could be certain things which could be internal from the management also. What about employees who have left the roles before the balance sheet date but paid after the balance sheet date? Somebody has left the role on 25th of March, and then his check goes to him on 2nd April. What do you do with that? Is there an issue? Is there an issue, first of all? That particular employee is not there in the database given to the actuary. Let us assume 10 people resign on 25th of March, and the gratuity settlement is made on 10th of April. For 31st March database given to the actuary, these 10 people will be missing. To their extent, their liability, gratuity liability will not even be there anywhere. They need not even be actually valued because full amount needs to be provided for them on 31st March because there is no assumption. They already finished on 25th March. Maybe there is a delay in making the payment. In those cases, it is important that we add that also to the liability. If you have actual valuation, we should add that to the liability. This is an audit checkpoint that we need to take care of. Especially in larger organizations, there could be many people, if there is a delay in cutting the check. Some people say, sir, that asset is already there. The check is coming only from the trust fund. Yes, the asset is there. But liability has not been taken. Because the database didn't remove those 10 people on 25th March itself. 31st March database did not have them. So to that extent, that asset also should be moved out. You can't compare apples with oranges. So this is something which is practically having an issue in many other companies. Larger companies, you have a bigger problem. Actuarial practice standard, we saw the guidance note on PF, exempted trust and all those things. Now you have something called APS 27, Actuarial Practice Standard, issued by the Institute of Actuaries. So it applies to all actuarial work related to employee benefits. The new standard seeks to enhance and strengthen the reporting requirements, and it supersedes all these standards, all these guidance notes. They had all these standards, all these have been removed, and then this particular master's, like a master circular in RBI, you got this. These are the general principles in that particular standard. Members' role should be clear, it says. That means, I don't know whether that means the actuary has to give an engagement letter. It's really up to them. Members must clearly state that the extent to which any third party can rely on the actuarial work, they have to give the limitations and all those things. If there is any uncertainty based on impact of legislation, they have to include the references. Reliance on third party or company data has to be given. The member must include a statement of benefits which have been valued and highlighting any changes from the most recent investigation. So current year, last year, they have to give certain data. Input data summary should be given, not the entire input data, and a sensitivity analysis should be given. And the technical application section of this standard says that the data should be reported. The section specifies items of related data which should be given in the report. Where does the data come from? Assumptions that have been taken, what model has been taken, report and output, all these things have to be given as per the particular standard. We may not have got a lot of visibility on this, but it is good to read this particular standard itself before we discuss with the actuary. Now we come to the last part, the disclosures. So these disclosures are only for defined benefit plans, what we are talking about. So we have some 137, 138 paragraphs, 135, 136, 137 and all. They explain that the characteristics of defined benefit plan associated risks have to be given. That is the first macro level disclosure, and that is covered by 139. Then it says, identify and explain the amounts in the financial statements arising from defined benefit plans, and that is covered in 140 to 144. What is that movement and all basically. Then it says, describe how the defined benefit plans may affect amount, timing and uncertainty of the future cash flows. It is more cash flow driven. That is in 145 to 147. And it also says, for meeting the above requirements, the level of detail, the emphasis to be placed, amount of aggregation or de-aggregation, you want to summarize or move it out, all those things left to you. So it gives you a lot of scope over there. You have to discuss on these things with the management on a case-to-case basis. I'll give some examples later. And it says more disclosures. If disclosures required as per India's 19 or other standards are insufficient to meet the macro level objectives, macro level objectives are these three bullet points. You can give more disclosures. Example, an entity may present analysis of present value of defined benefit obligations between active members, deferred members, pensioners. It says you can give all these things. We don't even meet the first criteria. This is all additional information that we are saying. So let us not get into the additional information now. Let us look at what we are supposed to give under 139 to 147. The disaggregation also I told you. Different geographies can be given. That is very much useful for consolidated financial statements. Sometimes, again, defined benefit plan gratuity. You may have some other benefit plan, and if you have a subsidiary abroad, as per the local laws of the company, or gratuity may be paid to your branch of this Indian company abroad. So those employees sitting in the branch outside India may be getting gratuity as per the policy of the company. If those things and all can be given in the disaggregation, different geographies and all those things can be given. Some flavors of segment reporting, that geographical segment, it is there in India's 19. So 139 talks about the characteristics of the defined benefit plan, what is the nature of the plan, regulatory framework. You have to talk about payment of gratuity act, you have to talk about the cap, the 5 years, all those things. Then what is the entity's responsibility for the governance of the plan? Are you giving it to the funding that? Are you having your own trust? Are you having LIC? All those things you can give. Descriptions of the risks have to be given. I got some examples for each and everything. We'll come to it a little later. Description of plan, amendments, curtailments, settlements. If you have any amendments and all, you'll have to give that. Suppose the cap has been moved now, last year. You have a cap as per policy. Law says cap has to be increased. You have to describe all those things over there. That amendments can be mandatory as per statute, or it could be internally, voluntarily changes also. Both can be there. Then 140 to 144 talks about the opening reconciliation that we normally give. It talks about any reimbursable rights. I don't know what it means, but it is there. It talks about the current service cost, past service cost, everything. It also talks about remeasurements of defined benefit, liability and asset. That is because of change in return on plan assets, actual gains and losses, or demographic assumptions. All these things can change. If these things change, it will come under remeasurement of defined benefit. These movements have to be given. So these are all very, very important. With this theory, please go and take one good big company's disclosures and match the disclosure with the particular paragraph and see. If we do that, we'll be able to get more clarity in this. By just seeing this, we may not get clarity. Then the fair value of plan assets into cash equivalents. So the assets are there into what? Is it into property? Is it into debt security? Is it with the bank? Is it with insurer funds? The assets breakdown percentage wise and needs to be given. Then the actual assumptions have to be given also. That's very basic thing. Sensitivity analysis has to be given. Many places companies do not give the sensitivity analysis, even though it is there in the actuarial report. As per his standard, APS 27 standard, we do not take that and give it here. So that is important. The methods and assumptions used in preparing the sensitivity analysis. And if those methods and assumptions change in the next year, that also has to be given. So these are fine-tuning, points over there. But the fact is that sensitivity analysis itself is not given in many companies. So we need to really enhance over there. From my limited knowledge, because there are 2-3 companies where I did not give in the first instance. Then my partner came and told me, hey, I'm giving it, please start giving it. So then, fortunately, we could make amends over there. So basically, I'm talking about my experience, not anybody's. So the asset liability matching strategy has to be given. So you know the gross liability, how it is going to be paid over a period of time, what is the age of the employees, your assets which are kept. If it is in bank deposit, you can pull it out. If it is in long-term investment, there could be asset liability mismatch. Just like in ALM in banks, here also it could be there. So all these things are supposed to talk about it. This is all coming as part of the risks also. This is not only ALM, is also in this second description of risk. It will come in both places. We are supposed to talk about all these things. It also says, when required by Ind AS 37, disclose information about contingent liabilities. How come contingent liabilities come? Then you have a trust fund outside. If that asset is subject to any dispute, and tomorrow they lose that because of that dispute, risk is here, we have to pay more. So, asset of the plant is under litigation, an adverse verdict may increase the liability of the entity. That is a contingent liability for the entity. So, as an auditor, we have to see, is the trust fund, is there any issue? Very similar to the expenses of the trust fund being, we have to fund for it also. Similar to that, we have to, any employee litigations, these are things I just thought about, but the fact that Ind AS 37 is linked to here is very, very important. Then, I have taken one particular company and given certain things over here. I'll quickly spend 5 minutes on this. Employee benefit is a subschedule as we normally talk about. This is due to Ind AS 1. Salaries, wages, contribution provident fund, gratuity expense. Here they have gratuity and special gratuity in this case. They have some VRS also. This is there. Please note here, the gratuity expense is 54.59. Just note, keep that number in your mind, 55, around 54, 55. There is something called finance costs, where they say interest on bank facilities, first line, second line others. In that others 77, others include interest on debentures, advance on customers, net interest expense on defined benefit plan. So when we saw the movement, we saw the interest cost in the DBO, gross DBO. We saw the interest income on the asset movement. Both the interest row items have been taken out, netted off, shown in the P&L, but not under employee costs, but under finance costs. This is there in Ind AS 19, but many companies do not give that. Most companies do not give that. Again, it's a call that we need to take. Is it a call?
I didn't give.
Okay. So again,
it's not due to borrowing. That's why they are not classed under finance.
There is, sir, if you go to fine tuning, if you go to literature on this, specifically Google, there could be a staff paper on why this has to come here in IFRS. IFRS has a very good system. They have something called basis of conclusions. You will be knowing better. Before the basis of conclusion comes, that gives, sir, today you go to your managing director and say, you have to do this because the standard says so. My father told me after converting meeting, don't tell him that way. Explain to him the logic. Because that logic only standard says so, if you tell him, he will accept. You tell him because the standard says so, he will say as a managing director, he will not. So, for that we have to know the basis of conclusion. Why the logic? And before the basis of conclusion comes, there would be something called, the staff will discuss. The standard setters will discuss. There will be staff papers. Out of staff papers, 8 people or 9 people discussing, 2 will dissent, giving their opinion. Why no? 7 will say okay and why yes. Those things will give you an insight on the different perspectives which are there. To that extent, you can go for this. But here I am only mentioning.
Is not there.
I went to this extent because I am going to speak here. Otherwise, I cannot have done it also. But I am just saying.
A lot of things we have not done.
Yeah. So coming to this, other financial liabilities, you have, where did I put that? Okay, VRS and all is there, non-current financial liability. In this, you have all the provisions and all those things.
So these provisions, when we make this interest, when it will get squared up?
Which one?
No, you said you have to debit interest.
Correct.
It's not a additional disclosure. It is a
P&L,
yes.
yes.
P&L, right? You credit liability.
That entire thing is there, sir. In the gratuity, you have the movement of gross liability, you have the movement of gross assets, and some amounts come for the P&L. It's not tally. So if you look at this company itself, all these things will tally to your notes and accounts.
That's right. But when it will get squared off, I am asking. When this liability will get knocked off?
Liability, as and when you fund it, both the gross keep on going up, it will come down when benefits are paid. Ultimately, the company is wound up, everything will disappear. That's it. Then, You have expenses, usual P&L. Here. So here what's happening is remeasurement of this place. Remeasurement of gains and losses of defined benefit plan is shown under retained earnings. You have cash flow hedge, fair value through OCI, foreign currency item, all this in OCI. But this particular thing, these are all reversing through the P&L. But this particular thing which is not reversing through P&L, some companies show it directly under retained earnings. Some companies show it as part of OCA only, in the separate column. And from when I saw that, for some companies based on, I could see a pattern from the auditors also that they do consistently this way in 2 or 3 cases. In 2 or 3 cases they do it the other way. So here in this company, they have shown the remeasurement and 55.71 retained earnings. So I just want to highlight this. You can have a look at it in many of the companies how things are doing it. They are doing it. So here, when they come to the other equity, again that 36.24 is other comprehensive income is shown under retained earnings. Whereas OCI, they have other columns over here. Some companies don't show this 36.24 under retained earnings. They have one more column here and bring it here. Ultimately, it is all part of reserves and surplus. But then whether if it is coming under reserves and surplus and OCA, it's part of shareholders' funds. But if you bring it under reserves and surplus, that too under retained earnings, dividend payouts can happen. So, according to me, I would prefer to put this OCA 36.24 as a separate column in items of OCA. Because we say it through OCA, not reversible and done. This is an anomaly which I have seen, but I am not able to get an explanation over here. But this, what I saw is what I want to just bring it to the table here. So coming back to this, so if you look at the P&L, this amount, this will tally to the notes and accounts. So what will happen is, the interest, when you look at the gross liability, gross assets, then some rows are taken to the P&L. Out of the total P&L, actual gains and losses are moved separately and taken to OCI. Balance P&L, the interest income expense is taken to finance costs. Balance will go to employee costs. That is why they have done it in this particular company. And they are given, if you see, these are the disclosures that we talked about in 139 to 147. They're talking about the Payment of Gratuity Act, which I talked about in 139. We have to talk about the framework, risk exposure. They have to talk about the liability risk, asset risk, unfunded plan risk. So these are all what we discussed in the disclosures, para 139 to 147. If you look at the 139 and 147 in conjunction with the actual disclosure of a particular company, you can match which paragraph is for which disclosure and see if there is anything which is missing. These are the assumptions that are being used. Again, if you see here, the withdrawal rate last age up to 30 years, 31, again they have different assumptions for different withdrawal rates. It requires a little more detailed study, but these are the things which are being given here. This is usual, what we already discussed, gross liability movement, asset movement. This is where I said, what they have done here is, they have taken the income separately here, income obligation on the plan assets, that 16.06 has gone to the finance cost, the balance has only gone to the P&L, employee cost. And here the funds managed by insurer is 100%, everything that they are given here. Then sensitivity analysis, they are given for each thing, discount rate, salary increment rate, withdrawal rate, if there is increase in 1% or decrease in 1% assumption, how it will affect the liabilities. This has been given. And the following are the expected benefit payments to the defined benefit plan in future years. How the funding is going to be done in future years, within 1 year, 1 to 5 years, all those things were given. AS15 para 120, AS15 para 120 had A to N or O also. There we are supposed to say how much the entity is expected to fund in the next 12 months. Here it is going much beyond that also. So there is a lot of assumptions, estimates and changes which are there in disclosures. We have to keep it in mind. So that's it. Accounting policies, I'm not going to spend time on this. It's pretty simple. I think it is there in the handouts, I'm not sure. This is for everything, not only defined benefit plan, for everything. Compare and contrast, difference between Ind AS 19 and IAS 19, not much difference. Ind AS 19 we take the government bonds, whereas in IAS 19 the government bonds can be used only if there is no deep market of high quality corporate bonds. So in international standards we take corporate bonds. In our scenario of Ind AS we take only government bonds. We have taken a carve out. But what we have done is, when we have IAS 19 thing retained with appropriate modifications for subsidiaries, associates and joint ventures domiciled outside India. So what we have done is, we have taken the principles of IAS 19 for companies which are outside India. To that extent we allowed them to use the high quality corporate bonds. We can take it. It cannot make a big difference, but there is a difference between Ind AS 19 and IAS 19. AS 15 and AS 19, basic differences, your actual gains and losses has to move to OCI. Asset returns in excess of discount rate, they are talking about this somewhere. It says it has to go to P&L and OCI, but this again get encapsulated in actual gains and losses. Past service costs, over a period of vesting and immediately in P&L, it was there earlier, the corridor approach has been removed. That's why I included it and deleted it. This is to show that the corridor approach has been removed. The difference which was there has been removed now, it is aligned. Asset liability matching strategies, in AS 15 was not required, it is very much required to be given in AS 19, which maybe not many of the companies are doing it. Experience history has to be given. In AS 15, we have to give the experience for the gross liability and gross assets for 5 years, whereas in AS 19 it has to be disclosed separately for 2 years only. So a slight reduction is there. Sensitivity analysis need not be given in AS 15, it has to be given in AS 19. Information of future cash flow, only next year contribution to be given in AS 15. In AS 19, description of the funding arrangements, policy that affect the future contribution, maturity profile of the defined benefit obligation. Based on that, how the funding is going to come, in conjunction with the asset liability management, disclosures have to be given. Okay, you have in old standard AS 15 revised has now undergoing a change where the exposure draft is coming for AS 15 revised, which is our company accounting standard rules, versus the new exposure draft for non-Ind AS companies. The new exposure draft has come. Okay, what are the changes between those two? That is something again which is here. I'm not going to dwell deep into that. There are quite a lot of changes, but most of these are changes between old AS 15 and Ind AS 19 also. So basically what they are trying to do is, you have, as I told you, you had old AS 15 which was retirement, only gratuity and other things. Then it has moved to revised standard. Now the revised standard is going further close to Ind AS 19. Ind AS 19 and IFRS are more or less same except for the discount part. So if this exposure draft comes into place, even the old even companies which are not in Ind AS platform will be more or less aligned to IFRS. That's what is going to happen, not only for this standard but for many other standards. Even Ind AS 1, the basic thing, how you give the financial statement, that is also being given as exposure draft in non-Ind AS platform. So if you have a separate trust, you have a separate trust, you have a gross liability, gross assets. Should we show the gross liability in our accounts, gross assets in our accounts? No, we don't have to do that. We only have to show the net amount which are there. That is what is here. Should gratuity fund be shown as part of a related party transaction? Should gratuity fund be included in consolidation of financial statements? Ind AS 24 talks about para 9b5. An entity is related to a reporting entity if any of the following condition applies. The entity is a post-employment benefit plan for the benefit of employees. That means if you have a gratuity fund, trust fund, it should be shown as a related party. But it need not be consolidated as per 110 because scope paragraph in 110, para 4b says this Ind AS applies to all entities except as follows. Post-employment benefit plans to which Ind AS 19 applies, there is a scope out in consolidation. So, if you have a trust fund for gratuity, you should show it as part of related parties in the standalone accounts, but it need not be consolidated for CFS. So, it will continue to be shown as a related party in CFS also. I think we'll stop here. FRRB I'm not going to discuss. Most of it has been taken care of in our discussions. Case studies, again we have discussed this one particular thing on Bharat Electronics, where they had a medical plan for retired employees. People who have retired, they can still come to the specific centers and get medical benefit. Government companies have this. This is a very good example of it's a long-term retirement benefit termination plan. So it says that it is based on other long-term benefits. It is not a VRS benefit. It is other long-term for retired employees, which has to be provided for. They did an actual valuation over there also. LTA should be considered for Ind AS 19. Leave travel allowance. Sometimes once in 4 years you get it. According to me, it should come in other long-term. So again, not many companies reckon that into their computation or disclosures. So this again, we already discussed this. Restructuring, I'm not getting into it. Okay, we cannot end a session without tax coming in. 43B. So you have in Ind AS something going to OCI, something going to P&L. If something is not hitting the P&L, you're taking the entire amount, two parts going. Let us say 100 rupees, 80 going to P&L, 20 going to OCI. 100 is the liability. You pay the liability next year. Will the income tax officer allow it? Because only 80 has gone to the P&L. So what has not gone to the P&L, how can he allow it on payment basis? So what is the answer to that? If the income tax officer says, sir, last time 80, 20, P&L 80, OCI 20, you are paid, disallowed because not paid. Next year you pay 100 fully. He allows only 80. He says because only 80 has hit the P&L, otherwise an OCI, I will not take it into consideration. What would be your answer to the company? How do we look into that?
I have one more question actually. You were talking about splitting the contribution between interest and contribution to the gratuity. If interest goes into finance costs, I don't think there is anything under 43B that says that interest should be disallowed, because interest to banks and financial institutions will be disallowed unless it's paid. But this particular interest, if it goes, I don't think it goes to even 43B.
Absolutely, sir. It's a twist on the tail. Yes, you're right. These are all complications which are there. But my point is, 43B, does it say that that should be debited to P&L account? Doesn't say. It says payment basis. There are many cases where when a company demerges, the liability as part of the demerged undertaking is part of gratuity liability or whatever 43B item goes to the resultant entity, and then when they make the payment, even though the hit has come to the earlier entity prior to demerger, on payment basis they will take tax.
In fact, even Supreme Court decisions are there where ModVat excise duty was paid.
Exactly.
Allowed, debited to stock.
Exactly.
Stock was allowed as an expense.
Exactly.
So there is a Supreme Court.
Exactly. So what they should do is when this type of demerger happens, they should not only send the liability, the deferred tax on the liability also should be sent. Then it will even out. So in this case, I think the answer would be that 43B is a section to see for allowability. It talks of provision to be paid and then allowed for tax purpose. There is no requirement that such payment has been debited to P&L. So even if it is so, OCI is only a modified form of P&L. Even though it is not reversible to P&L, it ultimately goes to shareholders' funds only. But that is only theoretical. Therefore, I think on payment basis, it should be allowed. We should only consider on the fact that it's allowed on payment basis. Debit to P&L is not something which is given as a necessary thing in 43B, and therefore we can go ahead. So that is my interpretation, but others may have different. Anyway, this is not part of Ind AS 19, but I thought we should have a tax waiver before we end this. Thanks a lot for your patient listening. We took almost 2.5 hours. So, any further questions, I'll be happy to field it. Thanks.
Thank you so much, sir, for sparing your precious time with us. Now may I call upon our Honorable Past Chairman, Mr. T.S. Kumar on the stage, please, to present an memento.
Yes, that was wonderful. Thank you, sir. I learned a lot. Thank you.
So just a second.
Can someone take a snap, please? Yes, sorry.
Thank you. Thank you. Thank you.
Thank you all for your patience throughout this program. Thank you all. Have a great time ahead.